Hi, this is Professor Karen Lin. In this video, I'm going to explain a question regarding assets versus expenses. The question is a very common question. When is the cash outflow an asset and when is it an expense? So, we are going to talk about this in two examples, and I'll explain to you the difference between assets and expenses. The first example, we purchase a van for $10,000. We pay cash and plan to use the van for 5 years. Now, most of my students understand this is using one asset in exchange for another asset, and both the van and the cash are assets. So if we are using the facet transaction analysis, you will see this transaction will decrease the cash asset for $10,000 because we pay for the van, but then in the same time we will be subtracting the non-cash asset, which is the van. Adding to the $10,000, which is the van, right? Now this is an asset. The van is an asset, and we pay cash. Some student would ask me, why didn't I put this to, for example, to expenses, right? It increases expenses because we are going to use the van eventually. Now, the key to this question lies in that a van will be used for more than a year, and it's unfair for us to count all of them as an expense for the current year, because the next 5 years we are going to use it. We're going to use it to generate revenues. The idea of expenses are the cost to generate revenue, right? So we can basically put all the $10,000 cash that we pay in the expenses, because it's not only used for this current period. Remember, income statement is only for the current period. So you have to do an asset. The next question my student would have is that, but I feel like it will become an expense eventually, which is true. So we will be talking about this in later of this course, where we introduce depreciation, which means the van is going to be used in the future, and its value would decrease when we use it. So let's assume because it's used for 5 years, let's assume every year we use the same amount of this van. After 5 years, this van is gone. So if that's the case, we know that for every year our van is reduced by $2,000, because we are using 1/5 of the van, right? 10,000 divided by 5. 10,000 divided by 5 years. So the van would be reducing by $2,000. Now this would increase the expenses for $2,000, which will eventually be reflected in the retained earnings, which reduces, it will be reflected in the retained earnings earned capital for $2,000, because it reduces the shareholder's claim. So you can see in this example, you can see that non-asset decreases when we use the van, and also the retained earnings decreases. If we are trying to find out the net effect of the purchase of the van and the use of the van for a year, we will see that eventually if I add the effect of these two transactions up, you will see that at the end of the first year, which means after 1 year, the van only has $8,000 left, because obviously after using it for a year, the value of the van dropped by $2,000, and there are only $8,000 left in the van to be used in the future. All right, with the first example illustrated, the second example would be easier to understand, where we prepaid a lease of van for a use of 6 months, and total we paid $6,000. Now at the beginning, when we pay for the van, it reduces the cash. It also, at this time, it also increased the right to use the van for lease of van for 6 months. So why is this not going to the expense, right? Directly. It's the same reason, because we don't believe when we purchase the right to use this van for 6 months, we don't believe it's been used all at once. So we are going to depreciate this lease in the future in the same fashion. Every month, if we are using monthly period as our accounting period, we are going to depreciate 1,000, 6,000 divided by 6, 1,000 per month. That will be reducing the value of this lease. It's the same thing. Another point related to this is prepaid expense. Now, prepaid expense, if you check my videos, prepaid expense are a lease of a van is also a prepaid. Like it's just like prepaying a phone card, prepaying the Wall Street Journal. So prepaying something means that we are entitled to use this asset for a future period of time. So it's basically meet the definition of assets, right? It gives us future benefits. It lasts for longer than one period, and it also under our control, or we own it. So a lease, a prepaid lease, is basically an asset rather than an expense. All right, I hope this helps, and if you have any questions, feel free to reach out.